You know what's the time again? Well, it's bull time again on the street. The Nifty 50 has scaled a new high of 19,388 as of 4 July 2023. Since the lows of March 2020 crash, that's a rise of 140%. Take a look at the table on your screen. It shows when the Nifty 50 crossed certain levels in its journey and how long it took. It was a long wait indeed. The Nifty 50 crossed the level of 18,000 in October 2021, and it took it nearly 21 months to cross the 19,000 mark. Now, no doubt, a new market high is an exciting time for investors, but it also brings challenges, dilemmas, and confusions. For example, is it the right time to begin investing or start a new SIP? Should you stop your SIPs at market highs and continue when the markets have cooled? Is it the right time to book your profits? In this video, we will answer such questions and discuss how should you invest at a market high. Hello and welcome to the ET Money channel. Before we begin, don't forget to subscribe to our channel and press the bell icon so you never miss a video from us. We will broadly cover three areas in this video. Number one, what can you do if you're looking to increase the amount you invest every month, or if you are someone who is looking to start investing now? Second, what can you do with your existing investments? Should you book profits? Should you stop your SIPs and wait for a correction and then restart? And finally, we will look at what not to do in bull markets. So let's begin with the first part. Now, the first quarter of the financial year is when most of us get our bonuses in annual increments. And we look at increasing our monthly investments as well. And if we haven't started investing, think of starting our investments. Now, markets being at all-time high can create doubt. It may not look like the best time to add or start new investments. After all, the fear of markets falling from this high can make it quite challenging to take the leap. These are legitimate fears and it's natural to feel this. So, should you wait for a correction? Let's look at the Nifty 50 performance since 2003 to find the answer to this question. In this chart, you can see the highs Nifty 50 has touched in this period. So a market high isn't a unique occurrence. There have been multiple highs and the market has kept going up from those highs. The point is simple. Just because the market has hit a high doesn't mean it can't go higher. Now, how high an index like Nifty 50 will keep going depends on the performance of the stocks that are part of the index. And stocks tend to go higher when the economic conditions are favorable, profits are rising, and there is no crisis on other fronts. So if you believe that the Indian economy will keep doing well and that businesses will keep making more money, then by extension, you have to believe that there is a possibility that the markets will keep going up as well. Of course, it's not a smooth straight road. There have been bumps in the past and there will be bumps along the way in the future as well. Even the current scenario has a few challenges of its own. For example, inflation is still high in many parts of the world. The Russia-Ukraine war is still going on. There are elections in India and US in 2024, so on and so forth. But if you're investing for the long run, you should do well. Now, I understand that you've heard this a lot of time. A lot of people say invest for the long term. But if you subscribe to our channel, you will know that we've always used data to explain our points. So why do we say invest long term and how do you benefit from it? Now, if you look at the Nifty 50 daily, weekly or monthly, it almost looks like someone has done an ECG report of his heart. You will see too many ups and downs. On the other hand, if you look at Nifty 50 movement and an interval of 5 years, it seems as if the markets never fall. They only keep going up. You can see it on the screen right now. That's why we say you don't need to worry about market highs and lows if you have a long-term horizon. You will feel as if markets only go up. So the first thing you must do is don't wait for a market correction. If you have a long-term horizon of 5 years or more, you can start investing now or add to your investments. Now, to reduce the risk, you can opt for SIPs instead of lump sums. Now, you might already know, but SIPs help you average your investments cost over time and reduce the risk of downside if the markets fall after you have invested. See the table on your screen. It shows what SIPs would have earned you had you started them at a market high over the last 20 years. As you can see, if you had started at market high, you would have still earned returns of about 11 to 14% on your SIPs. Now that's not bad at all. Alright, now see this table on your screen. It shows returns if SIPs are started at market lows. Now for our purposes, we have defined a market low as the lowest point between the two highs we saw at the video start. You can see that even if you had started investing at the lows, you would have still made returns of 11 to 14%. That's quite similar to what we saw in the case of market highs. Alright, now let's check what regular SIPs would have delivered during the past 5, 10, 15 and 20 years to understand what you would have earned had you stayed invested throughout these periods. Well, here your returns would be around 12 to 13%. Now this is quite similar to SIP returns had you started your SIPs at the time when markets were high or when the markets were low. So why does this happen? Why does starting at highs, lows or anywhere in the between seems to have little impact on your SIP returns? Well, that's the magic of SIPs. Since you invest across all market phases, you average your cost. Thus, starting at a particular market level has a little bearing on your aggregate returns. A word of caution, it requires you to continue to invest no matter what market's levels are and stay invested throughout. So think no more. You can start anew or make your first investment now. Now, if you're a new investor, choosing the right fund type can also help. Aggressive hybrid funds and balanced advantage funds can be good options. Aggressive hybrids have 20 to 35% debt and cushion of fall. Now in case of balanced advantage funds, which are also called dynamic asset allocation funds, the equity debt mix is dynamically adjusted based on market conditions with an aim to reduce the risk and increase the gains. See the table on your screen. It shows the maximum, minimum and average 5-year rolling returns of the Nifty 50, Nifty 500, aggressive hybrids and balanced advantage funds. Rolling returns help measure the consistency of performance across a specified period. We have looked at the returns across any 5 years since 2003. The last column of the table shows the volatility of these indices and categories. To measure volatility, we have used a metric called as standard deviation. The higher the value of standard deviation, the more volatility. So a lower number is better. As you can see, aggressive hybrid funds and balanced advantage funds have done a good job of containing downside and volatility as seen by the minimum returns and standard deviation. Of course, their returns are less than the pure equity Nifty 50 and Nifty 500, but that's understandable given the debt allocation in aggressive hybrids and balanced advantage funds. Alright, let's now move on to the next section of the video. Okay, if you've been investing in the markets for some time now, you would have seen a couple of highs yourself. You would have also jumped with joy whenever the markets hit a high. After all, it meant that you also made money. But after the initial excitement comes the question, should I continue investing or should I book profits? Again, it's natural to have such feelings. You have been patient enough and you may have seen difficult times when the markets dropped and your gains evaporated. So it's obvious that you would not want to lose your hard-earned gains again. So what should you do at a market high? Should you stop investing at a market high and resume investing after some time when the markets have digested their success? Well, we did some number crunching to see if pausing and restarting your investments was a brilliant idea or not. Let's say 4 investors have invested 10,000 rupees monthly for the last 20 years in the Nifty 50 index. Now, the first investor has done his SIP without any pause. The second investor halted her SIP for 2 months every time the market hit a high. The third investor halted her SIP for 4 months after the market hits a high. And the fourth investor does that for 6 months. See the table on your screen now. It shows the total corpus and the SIP returns of these 4 investors. As we can see, there is not much of a difference in the returns, but this stop and start method meant the final corpus was much less. So stopping your SIPs at market highs may not make sense. Now, there's another tempting idea. Why not book profits, exit the market and re-enter when the market's correct? So buy low and sell high. But does this work? Well, at the outset, doing this has some practical problems. When you exit the market, re-entering becomes difficult. You may not want to enter the market if the markets go higher. And if the markets go lower, you may still be unable to, as you would want to wait for an even lower level. This ultimately results in investors sitting on the sidelines as the markets keep marching ahead. See the chart on your screen now. It shows you what you would have earned had you invested in the Nifty 50 over the last 20 years versus what you would have earned if you had missed the best 20 and 50 days in the market. So booking your profits and sitting out of the market can thus affect your returns if that results in missing the best market days. So what should you do then? The ultimate antidote to the dilemma of booking profits or investing more is your asset allocation. Now say you have 75-25 allocation towards equity and debt. When the markets go high, your asset allocation will get skewed in favor of equity. Say it goes to 80-20. Now sell part of the equity and buy debt to return your asset allocation ratio to the target mix. This rebalancing will automatically take care of profit booking. Do the reverse of this in the bear market. Asset allocation and rebalancing beautifully take care of the problem of when to invest more in which asset. Now, as far as exiting the markets is concerned, you should do it only in two cases. Number one, if you need money, or number two, your investing requirements have changed. Now, you may need the money when your goal is realized or there is an emergency. Your requirements may change when, for example, you are nearing retirement and hence need to tone down your equity exposure. Apart from these two cases, you should avoid exiting the market. No matter where the markets are headed, try to stay invested and also keep investing as per your asset allocation. Okay, let's quickly summarize what we discussed in this section. Number one, stopping your SIPs at market highs and restarting them after time doesn't improve your return. However, it can result in a smaller corpus. Number two, booking profits at market peaks can make the re-entry difficult. It can also affect your returns if you miss out on the best days in the market while you are sitting on the sidelines. Number three, asset allocation and rebalancing are the ultimate solutions to the dilemma of when to invest and in which asset class. And number four, you should exit the markets only if you need money or your investing requirement has changed. Otherwise, just stay invested. Alright, let's move to the next section of the video. It's natural for investors to get excited when the markets are at a peak. Because virtually everything is going up, investors may want to try new things that may not go with their financial plans or that can be very risky. So let's see what are those things that you should actively avoid during bull markets. Mid and small caps often outperform in bull runs. Over the last 1 year, the mid and small cap indices are up by about 32% against the Nifty 50's 22%. So trying to ride the momentum in mid and small caps is tempting. However, mid and small caps are also more volatile and they can fall sharply if the markets correct. So invest in mid and small cap funds only if you have the required risk appetite. If you don't, staying with diversified equity fund categories is fine. Now, if you decide to invest in mid and small cap funds, avoid going overboard on them. At most, 30% of your portfolio should be allocated to them. On a general note, avoid chasing short-term returns in any fund category, including mid and small caps. Every bull run has its favorite sector or theme. It can be very tempting for investors to take exposure to it. However, you should avoid investing in sectoral and thematic funds as these funds can be more volatile. No sector or theme remains at the top always. They keep changing. Often, investors are stuck in sectoral or thematic funds long after the underlying sector theme has gone out of fashion. For instance, the PSU index has delivered a mouth-watering 38-39% returns over the last 1 year. But if you see its 5-year and 10-year returns, they stand at about 9% and 6% per annum. It is also very difficult for the average investor to take a call on the sector or the theme. Hence, it's better to invest in diversified equity funds and leave the decision to pick a sector or theme to a qualified fund manager. You can watch our video on sectoral and thematic funds on the link in the description below. Bull markets also see the rise of tipsters who may not have much experience in the markets themselves. As the markets scale high, suddenly there is a barrage of hot tips in your inbox and on WhatsApp. The financial community also gets hyperactive with market experts, brokers, and media come up with newer recommendations by the minute. Amidst all this noise, it's better to stick to your financial plan and continue to invest as per it. When the markets are on a boil, it's easy to forget what your financial plan is. The foundation of any financial plan is the emergency corpus, your life and your health insurance. These protect you from negative surprises. The larger this cushion, the better. So avoid diverting funds from your emergency fund to equity for short-term gains. It's also important to reassess your health and life insurance sum assured and opt for a bigger corpus if your needs have changed. Don't compromise on it just because your premiums may go up. This could leave you with lesser money to invest, but it's perfectly fine in the scheme of things. With this, we have come to the end of this video. I hope you liked it, and if you did, do share it with your friends and family. And I'll see you next soon with another insightful video. Till then, enjoy the bull ride, but don't lower your guard. Thanks for watching and have a good day.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.